Good afternoon, everybody. Bobby Piton here. Good to see a lot of familiar faces. Jose, Patrick, Ann. Good to see you all. Mary and Jules and so forth. I just want to make sure if you guys hear, if you guys are having any problem with my sound, please let me know right away. And I see nobody's saying anything, so I'm assuming the sound is good because I'm just live streaming back onto YouTube. It took a while to get it set back up. And so that's where we're at. I just lost like 7 followers. I know there was just like 13 people, not just dropped to 6. But what we're going to do is we're going to go over some economic data as well as 3 companies that reported. And so hopefully the light is a little better. Okay. And, so we're going to just jump right into it. Okay. With regards to some of the economic data that came out today, let me pull it up here. I'm just looking on my screen, hold on, because I want to share my screen. So maybe what we'll do is we'll go to, okay, I'll kind of go over this piece first. Factory orders came out today. The estimate was for 1% growth. It came in at 1.5% growth. So the good news is that there is more manufacturing coming back on, more manufacturing activity on U.S. soil is increasing. Now, why would that be? Well, over the past couple months, what we've seen is inflation kick up. And inflation's been kicking up for a variety of reasons. One, it could be due to money printing. We know that the Federal Reserve has expanded their balance sheet by almost $1 trillion since the election. $1 trillion. Now, keep in mind, about 12 years ago, the entire size of the Federal Reserve balance sheet was under $1 trillion. So within a matter of, 10 months, about 9 months, the Federal Reserve added the equivalent of the size of the balance sheet that existed 12 years ago. So it's a tremendous amount of liquidity in the system, and some of that liquidity is feeding in and driving higher prices in the economy. Okay, that's number one. Number two, we have been going through some supply side shocks. The supply side being we've been possibly cut off from some of our supply chain, which has been a very big risk for some time now, national security risk with regards to what's been going on with China. China has probably cut us off for some of the things that we need to properly function in our manufacturing sector, certain key components. And Peter, I think it was Dr. Navarro, he published a pretty detailed report about this. If I'm not mistaken, maybe a year, almost 2 years, maybe it's been 2 years ago now, outlining some of the critical components that we were at risk of having disrupted because of our relationship with China. So that has been happening. So here's the good news. Even though we haven't seen the massive kick-ups yet in factory orders, the inflation should signal more capacity coming online. Now, granted, it's a tricky thing, right? Because you don't want the cost of money going up too much while there's inflation. However, if you've noticed, interest rates are down, right? Interest rates, even though inflation has been running hot at 5%, the 10-year Treasury is under under 1.25%. Maybe the 20-year might be under 1.3%. So why is that significant? Well, if you know inflation's at 5%, but interest rates are 1.25%, you have a 4% negative spread. So for all things equal, this might be a really good way to entice people to build capacity. Okay? That's the deal, is that if you know that you're going to lose 4% of your purchasing power every year, unless you hustle and put the money to work, it's going to create some incentives to go into the real economy and build capacity, possibly in the manufacturing sector, which is what we really need to do. And so I'm not entirely sure what the game plan is on all this stuff. I'm just trying to make sense of it, just like anybody else, because economic signals are not working the way they historically behave. But then again, we're not in the traditional time in our history as a nation. We're in the middle of a war. whether people want to realize it or not, for the future of this country. We're at war with China, and it's an economic war. It's been going on for some time, and it's definitely a cultural war that we're living through. And there is an effort to do things that is impacting our way of life. It's literally there's a battle over supremacy for the next 100 years or possibly 1,000 years of how human behavior is going to exist on this planet. Now, it just so happens, I think that everything that I'm seeing is that we're winning that war, and that we are going to prevail ultimately, because free people will always prevail over enslaved serfs. I do believe that, and I think that the genie's out of the bag. I mean, we have our freedom, and there's hundreds of millions of Americans that are going to do what it is that they need to do to remain free. And I have confidence in the American people that we will continue to do that, and we'll step up as we have been to correct things. So let's go to one of the companies that reported, and I'm going to share my screen. Let's make sure it works okay, and then we'll go to some other economic data. Hold on here. So I go to sec.gov. I've talked about this before. Sec.gov is let me see here, and let me make sure that when I share this screen that this is working okay. Hold on. And then we're going to share the screen. Okay. And so let me see. We're going to share that. Okay. So here's the screen that we're going to share. Let me see. We'll expand this. Okay. And then I'll just expand it here. Can you guys let me know if for some reason you can't hear it? But this is Eaton Corporation. Okay, so Eaton Corporation reported earnings today. It's a company that does power management, and it serves the construction, commercial, aerospace markets. And this company is obviously it's one of the largest players. I mean, that's not obvious, and unless you looked at it before. It's one of the largest companies in the space. It's doing about $20 billion in revenue. But what is interesting is it's moved over to Dublin, Ireland, right, to minimize its tax bill. And once it moved over there, its net profit margin. I got to look at the exact year that it moved over. But their net profit margin was about 9% or so, and now it's almost 13%. So you can see that here's once again a multinational that moved over to Ireland and doesn't pay the tax rates as same as corporations in the United States. But you can tell that they're obviously doing pretty well for themselves. The revenues were up 18.6%. Year over year. I'm sorry, the margins were 18.6%. Revenues were not as strong as you would think. The revenues were, let me see, sales in second quarter were up 35%. Now keep in mind last year that 35% increase was off of low base because of what was happening with the virus. And so, that's not exactly the best of comparisons, but nonetheless, this is an industrial company. So to rebound as strongly as it did, $5.2 billion, you're talking about a $20 billion plus run rate. This company, before this whole pandemic hit, was doing about $21 to $22 billion a year in revenue. So it's back on track to be doing what it did back in 2019. And so the stock is reflecting that. The stock is now literally, it was about $60 a year ago, and now it's at $160. So the stock is up a whopping 150% or so in the past 12 months. And they're raising their operating cash flow basically for the full year by $200 million. You can see that number right here. And so the earnings are up 37% year over year is what they're showing. So they raised their earnings guidance to almost $7 a share. So this company is selling for about 23, 24 times earnings right now. And so things are going well. And now this company is a good sign for the United States in general, because if we're seeing things show back up on U.S. soil in terms of this segment of the economy, this is wonderful. Like sales of electrical Americas segment was up 24% right here. So you don't need this business unless you're building new buildings in the U.S., right? And you're building new facilities. So this is a really good sign to see that this segment is doing well. That's the Americas segment. Obviously, globally, it's also up. So worldwide, there is a rebound across the global economy. It's up actually a little more, 28%. Aerospace was up 36% right here. This is for this is quarter on quarter, folks. These are not annualized numbers. This is what they did in business for the quarter, $625 million. And so the rolling average of orders was down, which would be a concern. So to see this going down, we need to understand why and what you would do. It's not going to show that here. What you would need to do is listen to the earnings call. If you wanted to find out what was going on, you would want to listen to the earnings call and see what the management team said with regards to that statistic. But it's not listed here that I've seen so far. So the vehicle segment up 106%. As we all know, right now there is a big issue with the shortage of chips in the automotive sectors. But so I'm wondering, this vehicle segment, what exactly are they producing for the vehicles? But you can see right here, year over year, the 6 months number, which took into account, prior to the virus hitting, it's up year over year now, 9.9 versus 8.6. So that's quite a change. Profits have pretty much doubled off of the low in the 6 month period. And for the second quarter, which is when the virus really hit, you can see that profits are up tenfold, essentially, right? 506, 51 times 10 would be 510. It's 506. So it's almost tenfold. But you can see that that's all rebounded. Now, what's interesting is that the share count of this company was about 440 million shares in 2017. The number of shares outstanding is now 401 million. So they've bought back 10% of the shares in the past 3 years. That gives you an idea how well they've done, I guess, and how much you could say how much money they've been making, because the company is definitely doing pretty well, to say the least. And more importantly, if you look, $3 billion of plant and equipment. I mean, it's a big company. It's worth over $60 billion, well over $60 billion. It doesn't have a lot of debt. Current liabilities are $9 billion. Long-term debt is only $8.7 billion. I say only 8.7 because when you look at the total assets, they did an acquisition that's $15 billion here. This $3 billion in plant and equipment is probably understated. But in general, this company, if you look at current assets at $9.8 billion, current liabilities are $9 billion, so they have about $1 billion in net working capital, and that's including this $3.3 billion of short-term debt that they'll probably roll. But in general, it's not an absurd amount of debt, given how strong the cash flow is of this company. So the cash flow is what the key thing to kind of look at, because this company, to have $9 billion of debt or so, but to have almost $2 billion of free cash flow right here, 484. Now keep in mind, 484 times 4 is almost $2 billion. To be at 5 times free cash flow is a very, very healthy, manageable level of debt. And so there's a reason why this stock has been having such an incredible run. It's a very well-run company. I don't have any opinion on the current valuation of it, so please don't interpret that. This is all done for educational purposes, folks. Any of the companies that I'm listing, I'm basically just showing you what you could do if you wanted to look into these companies on your own. I highly recommend going to the filings on companies versus reading what the media says, because the filings will give you a better reflection of what's taking place and what the truth is and so forth. Um, and so, that's that. But if they acquired Trip Light based in Chicago, one person, one vote, that might help explain why the debt probably increased. But and probably if they broke it out, let's take a look here. Let me see here. So they're acquiring some other companies. Okay, so this was 400 million. So it's about $100 million of the revenue right here. Because I'm assuming, they purchased it for 1.65. So there you go. That's why their debt went up. So the fact that they acquired that company with cash, because the debt went up, goes to show you what they think of their business. They don't want to give up the shares. And so they've done a bunch of acquisitions. Some, there are obviously, look, another one right here, sold its lighting business. Hold on. So they bought this last year for $1.4 billion. And then they bought this a year later. Interesting. So, I wonder if they're identical businesses, but it is kind of interesting that they did that. All right, so let's go to the next one here. So we're going to be done with Eaton. So now we're going to go to Fidelity National Information Services. And this company here, just go to the 10Q. We need to look at the earnings. Here we go. So we're going to go right here. Okay. So Fidelity National Information Services, they do banking and payment technology solutions. So this is based out of Florida. It's also it's a company that did some major acquisitions. I guess they did an acquisition a few years ago where they almost doubled the share count back in 2019. They're doing quite a bit in business. This thing is doing almost $14 billion a year in business. This stock happens to be down today, so I'm assuming that it could be down for a lot of reasons. It's down $9 or about 7%. But keep in mind, folks, this company is worth $80 billion. Let me say that again, $80,000 million. That's what this thing is worth. So for this company to be worth $80 billion, and it's doing $14 billion in revenue, so 6 times 14 is $84 billion. So it's almost 6 times revenue. Now, on the surface, that looks like a pretty rich valuation because their best margins in this company's history have been about 11% net margins. So to be selling at 6 times implies they should be doing closer to 25, 30% margins, assuming no growth. So it's very interesting that's the valuation that this thing would be selling for. They're paying it looks as though about a 1% dividend. The book value of the company is definitely not as good as it looks. They're trying to say that the book value is $80 a share, but essentially $67 billion of it is goodwill. So we'll see that down there. This is probably from all the acquisitions that they've made. But people are paying for, what are they paying for? Here we go. They're paying for the EBITDA. So earnings before interest, tax, depreciation, and amortization, $1.5 billion. So people are basically saying, Bobby, don't worry about the net margin. We're going to focus on cash. And right now, based on the cash, the adjusted earnings, if you notice here, what they tell the world is they make this, $341 million. But then when you adjust the earnings for goodwill, you see $1 billion. So all of a sudden, the valuation doesn't look as expensive because I said that this thing is pricing as though it's 25 to 30% margin. Well, what's $1 billion divided by 3.5 billion? Well, $1 billion divided by 3.475, drum roll, is 28.77%. So just like that. I just said it on the cusp, looking at the valuation, it should have been selling for about, it was implying a 25 to 30% margin. And when you take the adjusted net earnings and you divide it by the revenue, this number here, the 1,004, and you divide it by this number here, you get about 29%. So there you go. That's why the valuation is what it is. And so, on the surface, it does not look as though it's overvalued. So now, why is this important, folks? Because if you looked at the net margin of this business and it's at 10%, but then you're like, wow, it's only a 10% margin, but why is it selling for $80 billion? But you got to remember it has another $14 billion of debt. So it's actually $94 billion valuation. You really need to look at what the cash flow generation is. Wow. So they've actually increased the share count by 25 million shares. Unbelievable. It was at 600 million. Now it's 624. But anyways, super, super important. And you have to, this is why it's so important that you look at the cash flow statement. It doesn't matter what they report on the income statement. If you don't check it out with how it looks on the cash flow statement and the balance sheet, you can get hoodwinked. You can have problems. You think something is cheaper than it is, or something is more expensive than it is if you don't look at that. But right here, you can see $53 billion of goodwill right there, $53 billion. And then $12.7 billion of intangible assets. So I'm not sure. Goodwill is usually attributable to acquisitions. This is something they must be valuing their data at that or something. We'd have to. It's probably in the 10K if you wanted to understand what exactly are they valuing as an intangible asset of $12.7 billion. Because they have a separate software number here too, $3.4 billion of software. But you can see right here, long-term debt, $16 billion. So that's a lot of money. $16 billion of debt. They're making $4 billion. It's 4 times their debt. If they're making $1 billion a quarter, when you take out non-cash charges, and not the $343 million, $1 billion times 4 is $4 billion. $4 billion goes into $16 billion 4 times. Okay. So net equity, once again, they have a negative book value because of the goodwill if you subtracted that out. So here we go. Look at this cash. This is for 6 months. So you can see that what they're telling you, that number is $1 billion versus 343, shows up in the cash flow. If you see that, $1.8 billion of cash. But look at this. This is why depreciation and amortization of goodwill, $1.9 billion right there. So it ties out. So this number... But, it's funny because they showed a loss, right? So from a tax perspective, they're booking a loss that they don't have to pay taxes. But then, when it comes down to it, the money shows up. So they're getting a little bit of the best of both worlds on that one. Repaying of borrowings. Wow. So they borrowed $27 billion. Said they must have had to roll all their debt. Let me see here. See, they have a negative working capital. They have a negative working capital of about $2.5 billion. So, but keep in mind, folks, this is a card issuer and transaction processor. So they need a lot of cash to do their business. And my guess is a lot of the cash and the debt on the balance sheet, that's what it's for. It's just to actually run their business. And so, it's a timing of cash flows. So, in terms of the net working capital, that could become an issue if they ever run into a cash crunch and the credit markets don't want to give them any more money. It could literally put them out of business, which is a huge risk for them to do that. The long-term debt, I'm assuming they're rolling it to deal with this. And so that's where we're at, folks. This thing, I don't have, once again, educational purposes only. It's a very interesting company. It's done quite well over time, and they do seem to do acquisitions. And they like to show that they're not really making it that much money. Now, keep in mind, this company, I just want to pull up a quick little stock chart for you. So if we just go to the stock chart on this, okay, we're going to expand this, okay, right here. So we're going to go to max. I want to point this out. Why am I pointing this out? Because right here, okay, right here, the stock in 2012 was $22 a share, or 2011. So stock was $22 a share in 2011. Now, if you looked at 2011, you'd be like, wow, Bobby, $22, it's worth $5 billion. $5 billion of debt. It only had a 7-8% return on capital. It doesn't look like it's a good buy. You wouldn't think to buy it at all. It had $4.5 billion of debt, but you didn't look at why they needed the debt, and you would have avoided this stock if you looked at traditional metrics. But let's see what it's at. Okay, the low today was 126.66. Nice 666 numbers there. But the stock's at 130. So in a 10-year period, you've made about made over 400%, or 5 times your money. And so that's the deal. So, obviously it's up 810% since, I guess, it went public back in 2001, which is still, that's a phenomenal return. Any way you slice it, to be up 810%. So that's Fidelity National Services. And then the last one we're going to discuss is a company called BP. And you guys have probably all bought some gas from British Petroleum. Let's see if we can find that one. Hold on. That's Eaton. Here we go. Here's BP. Okay. So BP, British Petroleum. Okay. Now, this is not a U.S. company. So this is actually it's based out of the UK, out of England. And so obviously we've all seen what's happened to oil prices. Oil prices have been on a huge run, especially since the election. They've gone straight up. And BP, right now, this stock, if you look at it, we just pull up BP real quick. It's interesting because a lot of oil companies, this one's up 6% today. But, 1 year, it was started the year at $20. It's up at $25.50. But, it's yielding almost a 5% dividend. But you can see this stock hit $15 in October of last year. And so look at this 5-year number, $47. Actually, what is that? About $47. You can see it's had some trouble here, right? This was the virus last year. Stock dropped from 39 all the way down to 17 in March of last year. So obviously oil has had a pretty bumpy road, to say the least. But if you look at how it's doing now, they lost $16 billion last year. Unbelievable, like how much money an oil company could lose. And you ask yourself a question: why did this thing lose so much money? And if you look at what happened last year, there was a very brief period of time, if you recall, where you had to pay to have somebody buy your oil. You had to pay somebody to buy your oil. They ran out of capacity, and so I don't know if they got caught on the flips, on the side of the trade where they had to pay out. But a lot of oil companies lost a lot of money during that time. You could see that their profit is now obviously, I'm sure they're much happier with life. They made $3.1 billion versus losing almost 17 a year ago. And that's down from the first quarter of this year. So they might have put some hedges in place. But their cash flow, obviously last year was probably an impairment charge, because you can look right here and see that their operating cash flow was still positive, $3.7 billion. And then they just slashed CapEx. They were still able to make their dividend payment. I'm sorry. I don't think they ever cut the dividend. Let me take a look here. Last year, no, they never cut their dividend. So even though they ran into all that trouble, actually they cut it to 31 cents, but they didn't cut it to zero. So they did cut it to preserve cash. But even with all the problems with that that they probably wrote down goodwill, if I had to guess, they still managed to have positive cash flow. So the cash flow was $3.737 billion, and now it's $5.41 billion. But look at what they did with CapEx. So CapEx is down year over year, even though they have a lot more cash flow. They've only spent $2.5 billion. So then they bought back $500 million worth of stock. That's what that number is there. And look at this, folks. So obviously, last year kind of probably spooked them a little bit. Now that times are a little better, look at this. They went from $40.9 billion of debt, net debt, to 32.7. So they've decided, you know what? We don't need this stinking debt. We're going to cut down our leverage, and you can see their net working capital. We'll see on their balance sheet here. If their net debt dropped by essentially $8 billion, BP is doing a nice job. I mean, I don't know what to tell you. They're definitely doing a nice job. Once again, I don't have any opinion on the valuation here, folks. I'm just talking about what they're doing with how they're running things. Paying down the debt is a good thing. So they're basically telling us global stocks are expected to decline in the first half of 2022. Oil demand is expected to recover. And then they're talking about OPEC. We expect third quarter reported upstream to be higher. So, obviously the stock is up today about 5%. So I think the market is liking what they heard from them. So they said as a result, the first half of the year divestments. So that's what they divested. That's why they probably paid that $8 billion down. And they're going to try to pay down, they're going to divest another $25 billion. So there you go. They're probably going to keep delevering. So maybe they're just going to be more of an oil management company. I would have to look to see what businesses are they divesting. Usually you want to divest the capital heavy ones and go into low ones, which is what they might be doing. So then here's their royalties. Let's see here. So let's take a look here. So I think I was just trying to find their balance sheet. I just wanted to see their cash flow statement. Hold on a second. This is the revenue. Okay, so their revenue from a year ago went from 20 billion 8 to 37.6. You see their profit, attributable to BP shareholders, and then hold on one second, trying to find. Here we go. Fixed assets. So fixed assets, they have 167 billion. Property, plant, and equipment, 116 billion. And current liabilities of let me see. So 84 billion of total assets. Now keep in mind, this is the largest oil company in the UK, one of the largest in the world. And so some of that might be goodwill. But now if we look, they have $80 billion of equity. So 14 billion of non-controlling interests that own the shares. The company is currently at $93 billion of total equity, which is right in line with the market cap of the company. It's worth about $93 billion. So you're buying it about 1 times book value. If you at this current valuation, if you believe in the goodwill numbers. So that's where we're at, folks. So let me see here. Okay. So, folks, those are the 3 companies I went over. And let me see here. If you, I guess what I'll do is I'll chime in tomorrow. We'll see what companies are reporting. If for some reason there aren't any companies reporting, I may find something that looks interesting that has already reported and bring it up to, bring everybody up to speed on it. I hope you guys find this helpful. It's important, like I said, always remember ISBS, CF, right? It doesn't matter how I guess all these things all tie together. So, balance sheet, income statement, and cash flow statement, they all need to tie together. It's important that you take the time to understand how those 3 things are working with regards to the movement of money in and out of the business. If you want to understand which companies you should be buying. So I hope you guys found it helpful, and I will see you tomorrow at 11:30 Central Standard Time. Now that YouTube let me back on. So have a wonderful day or a wonderful afternoon, and I'll talk to you soon. Thank you.